G'day expats and welcome to another episode of Expat Chat, episode 124 today. And not joined by James Ridley, my normal co-host, joined by Adam Prentice, who is a financial planner here in the DIFC Dubai office. G'day, Adam.
G'day, Brett, and hello, everyone. Pleasure to be here. I hope James and Co are at the airport enjoying themselves.
That's right. So for those folks who are following along in the background, James, Ben and Jeremy. So James obviously runs the Australian office. Ben heads up our tax office and Jeremy heads up the mortgage office. Are all on the way over to sunny Dubai. So we can start our roadshow tour, Riyadh, Dubai and Abu Dhabi next week. So right now they're actually sitting at the airport, but we wanted to make sure that the Expat Chat continued. And to me, it's a trade up to actually have Adam instead of James. So, mate, good to have you on the channel.
Thanks. That's a very high compliment. I hope James is enjoying a glass of champagne.
Yeah, no, James, he's probably got a little, cocktail with a little umbrella in it, something like that. So, anyway, we won't tell him about this conversation until he hears it later. So, folks, today we're going to be talking about the changes to non-dom status in the UK. Obviously, Labor winning the election this year and how that's going to affect Australian expats. So, mate, let's get the show on the road. Let's get the disclaimer out of the way to complete the compliance officers happy of the world. All the information that we're going to talk about today is to be treated as informational and educational purposes only. Please do not construe this as personal advice. If you do need to get personal advice about your circumstances, reach out to a specialist like Atlas. So, Adam, I'm going to chuck you straight in, mate. Talk about the changes, what's been announced, what do we know, what do we not know, and what does the pathway look like over the next 6 to 12 months?
Yeah, definitely. So I guess just starting on the non-dom rules, they've been established since 1799 looking at it and been around for ages. But in simple terms, being non-domiciled in the UK means that while an individual may live and work in the UK, their permanent home or domicile is considered elsewhere. Under this status, individuals are only taxed on their UK income and gains. So any foreign income or gains are outside the remittance of the UK unless they're brought into the country. So the attractiveness of it is to attract, international wealth to the UK. Legally allowed foreigners to avoid paying taxes on overseas income.
So in layman's terms, I moved to the UK. I've got investments or a business in another country. I can claim non-dom status. I'll pay tax in the UK on what I earn in the UK, but I won't pay tax on the stuff that's outside of the country. Is that right?
Yep. As it stands currently. Well, we'll see if that continues. I guess coming up is an October budget on the 30th, and there's been a lot of text around and draft rulings around non-dom status. It's been a focal point in the UK tax system for years. A lot of people unhappy about it. So, from what we've seen, if you've been in the UK for over 4 years, on the 6th of April 2025 as a non-dom, you may become subject to UK tax on your worldwide income. The 4-year foreign income and capital gains tax regime has been introduced as well for those who have been here for less of that time or been in the UK for less of that time. So that regime will allow an individual who's eligible to claim relief if they dispose of a foreign asset within that qualifying 4-year period. They won't be liable to UK taxes on the gain arising from the sale. That's pretty much it. And then anyone who's been a UK resident for after 6th of April 2025 that hasn't been a resident for the last 10 years, you also qualify for the FIG regime, as they call it, and exempt for 4 years.
Okay, so I guess where it's going from is right now those folks can claim non-dom as of next year. As soon as you're there as a resident, you've got 4 years. Let's say, for example, someone's flying in from Sydney, Melbourne, Brisbane. June next year, they've virtually got 4 years where they're technically a non-dom, but then once they cross that 4-year line, then everything becomes accessible.
Yeah, definitely. And look, it is draft ruling. We should know more in a few weeks, but yeah, bigger impacts for Australians specifically. Yeah, and then we can jump into what the changes mean. So negative gearing is, you know, the backbone of the Australian society. You know, everyone has a property investment with debt against it. That debt is tax deductible in Australia, as we all know, from tax losses from the property. What it means is if you lose that non-dom status, that means in the UK you aren't eligible to claim that as a tax deduction. They're a big no-no on negative gearing. So yeah, it may mean higher tax liabilities for Australians with investment properties.
Back in Oz. Yeah, no, it's a good point. It sort of dovetails into our episode last week with James, where we talked about potential changes to negative gearing back in Oz as well too. So, if the UK does go down this route and Australia goes down this route, those folks in the UK especially may need to look at revisiting their asset base and how it's performing, because they could be out of pocket, quite measurably, going
Yeah,
forward.
yeah. Yeah, definitely. And it's a strategy that we use a lot, Brett, generating tax losses and, using them in a later date. And that still exists, right?
Look, it does. And I think the biggest thing with this sort of stuff is, you know, and like we talked about last week, sometimes people buy this property or that property not because it's a great investment, but to create that negative gearing while you are a resident of Australia. But with, I guess, the tentacles now, HMRC now extending out further in a shorter amount of time, um, these sort of opportunities are an opportunity to go through and revisit your balance sheet. And I guess most folks, if they're doing, obviously ignoring those who sort of go to the UK to pull a pint and travel through Europe, but for those who do go for a longer period of time, this sort of reminds me of the Hart Tax Act in the US, where there's an 8-year demarcation where you become what's called a covered expatriate if you're in the US for greater than 8 years, and all of your assets become assessable when you do go to leave the country. It seems like very much a similar sort of scenario now becoming into the UK, where once you cross that 4-year threshold, then things become a lot more complicated.
Yeah, definitely. And I guess that leads into the second point of franking credits, another thing Australian investors benefit from. So for your knowledge, franking credits, put simply, if I own shares in CBA, that company's already paid tax on their profits. So why should I pay tax on already taxed profits if I receive a dividend? So what we get as investors is a franking credit attached to the dividend. Normally that's around 30%, the company tax rate. So yeah, how that's taxed in Australia is, let's say we receive a dividend of $100 from CBA with a 30% franking credit attached, that's $130. We'll pay tax at our marginal tax rate at that amount. And then what we get is a $30 credit back, which is the franking credit. If you're on the top marginal tax rate in Australia, that leads to an overall tax rate of around 24, just under 24% on the dividend, which is a huge benefit considering top marginal tax rate's 47%. What the UK have done, if you lose non-dom status, they will tax you on the full 130. And as we know, top marginal tax rate in the UK is 45%. It's not an apples to apples comparison due to different, thresholds in income tax rates between the two countries. But hey, I guess people aren't going to the UK for the sunny weather. They're going for higher
Opportunity.
incomes.
And look, and as you say, it's these little things that are going to shift the needle when it comes to, you know, getting the juice from the squeeze, as they call it, when it comes to making the most of your time overseas. Obviously, most folks, as you say correctly, they're not going to the UK for the weather. It's like people don't move to Dubai, because they like sand and sun. You come here for the opportunity. You go to the UK for a bigger market, bigger scope of capacity when it comes to, sort of climbing up the ladder when it comes to your career. But yeah, I think people are now going to have to start to be more measured in their view of whether they're going to extend past that 4-year period or they're going to call it quits at 3.5, because obviously that thing will change a lot when it comes to all of those worldwide assets being brought into the tax equation.
Yeah, definitely. And the most worrying people have been there already for over 4 years, so that they're the ones that I guess should be worrying about this sort of stuff. Those who are going over for, 2 year stint, no worries at all. But yeah, it's those longer term residents, and yeah, we've got a few of them.
Yeah, we often find most folks we deal with are actually there for sort of 8, 10, 15 years. And then you've got all these other conversations about inheritance tax and all those sort of things that come into the equation as well. And, there are talks about, changing the inheritance tax. Do you want to run through quickly what they're looking at doing there?
Yeah, definitely. So the UK generally charges a 40% inheritance tax on people who have estate assets over £325,000. Just noting, transfers between spouses are tax exempt. However, if you're passing down to, children, including adopted, fostered stepchildren or a grandchild, your threshold increases to £500,000. That's around 970,000 Oz as at today. Anything above that will be taxed. So since non-doms are up in the air, Australian expats could get caught out by this, even if they have returned to Australia. So what that means is the current proposal is after 10 years of UK residence, an individual's worldwide assets would fall into the scope of inheritance tax compared to the 15 years now. So anyone leaving the UK and becoming a non-resident, so if you were to repatriate back to Australia, after 10 years or more of residence in the UK, you would be stuck in that tail, as they call it. So pretty much you have to survive for an additional 10 years in Australia to get out of that inheritance, the sphere. The current tail's 3 years, so that is a big difference.
Yeah, and like, we were sort of talking the other day, just telling clients, don't die for 10 years.
Yeah.
Year 11, you can do what you want, but just don't die for 10 years.
Oh, it's pretty grim conversation to have.
But it is. But I think, it's sort of like we always talk about clients when we're doing, planning out and strategies and those sort of things. You can quite easily demarcate milestones along the way to sort of, if you're new to the expat journey in the UK, you can sort of put these, markers along the line to say, rightio, am I going to, at 3.5 years, am I going to stay? Where am I going to go? If you are going to stay, great. Next milestone is 9.5 years. That 10-year inheritance tax, sort of regime being brought into it. If you are going to stay, then more than likely you're going to stay for substantially longer than 10 years if you are going to go through that. But it's important because we do meet people from time to time, not just in the UK, but all around the world, who aren't aware of these milestones that you have to be aware of, and they cross this threshold, sometimes by a day or a week or a month, unaware of if they'd just done it a little bit earlier, then they wouldn't have all of these other issues to deal with. So I think it's important, and that's why we do the podcast and webinars and seminars and all those things, to just make people informed and say, hey, heads up, chuck this in your calendar, chuck it in Outlook, just to say, at this stage, what are we doing? Are we going to commit to go further? Is the economic upside going to warrant the sort of the downside of becoming, sort of a long-term UK resident? And if it does, then at least you're acting on informed information.
Yeah, most definitely. What's your phrase? Prior preparation prevents
piss poor performance. Yeah, the 5 Ps. And I think you can apply that in life, in career, and work, and business, and finance. It's all those sort of things, and it really comes back to, we try and harp on, and we may sound like we're harping on, but we're doing it from a good intent. It's important that you understand the known knowns, the known unknowns, the unknown unknowns, when it comes to these sort of things, because then you can make informed decisions. I was with a client last night and we're talking about different options they're looking at doing with their finances. And I said, I can give you the Excel spreadsheet answer that gives you the perfect optimized result. but you may totally disagree with that because from a lifestyle point of view or personal point of view, you want to do something else. And that's okay. But at least you're doing it fully informed and you understand all the moving parts of what's going on and you're happy to take those on board. Whereas, unfortunately, a lot of folks out there are acting pretty blindly or, they'll take that she'll be right approach to managing their finances as an expat. And then they're the first to complain about something getting caught because they didn't do their research or didn't seek advice.
Yeah, definitely. And if you're in the UK and you're loving life there and want to stay there, sure, like we can plan around all of these things, inheritance tax, franking credits, etc. And yeah, just get it all on paper and you understand it.
Right, spot on. So, look, I think we wrap it up there. Just a bit of housekeeping, folks. Please send us the love with ratings and reviews and subscriptions. These sort of things, I say it often, but they do help us get to a broader market. They do help us get out there to educate expats. So it takes you 2 seconds. Just scroll down, give us a review. Also, too, we've got the seminars next week. Adam and I fly out first thing on Sunday morning into Riyadh. The boys fly in later that afternoon. We'll be exhibiting at the Aussie Expo Monday and Tuesday in CAF D. If you're in Riyadh, you know exactly where that is. Come along and say good day. We have the seminar that night, which is now sold out. So unfortunately, I don't think there's any tickets left. That's been it's crazy the response rate we've had there. That's on Monday night. On the Wednesday night, we're in Dubai. There are still seats available. They are going very, very quickly. So there's a link down below to our events calendar. You can register for these events. And then Thursday night, there's Abu Dhabi. I think there's like 10 seats left. So if you are in Abu Dhabi, you want to get along, please, do it now because this is not some sales gimmick. We're not spivvy marketers trying to, sell product. It's no shit. These seats are going. So if you do want to come along, it's the first time that all of us, there'll be 5 of us, Adam, myself, and the 3 boys coming from Oz, are in one room. And I'm not sure whether we'll be able to do it again next year or year after because calendars and everything. So if you do want to go to one space and learn about all the topics that expats have to contend with, taxes, private rulings, tax residency, financial planning, strategies, asset management, wealth management, mortgages, 2.5 hours well spent of your time. So if you are keen, go down to the description in the link below, click on the events, register because those seats are selling fast. So, mate, I think we give the good folks their earballs back for other things to focus on and we'll call it a day.
Yep, hopefully see them next week too.
Cheers, mate. Thanks for your help.
Thanks. Bye.